Welcome to this explainer. Okay, today we are taking a look at an absolute retail giant, Home Depot. But we're not just doing a standard overview. We're unpacking a highly contrarian investment thesis based on their Q2 Fiscal 2026 earnings. Right now, the whole narrative around real estate and home improvement is just incredibly gloomy. But the data tells a remarkably different story. The core thesis we're exploring today is actually pretty simple. Home Depot is executing flawlessly in a highly difficult environment, and the broader market? Well, it's pricing in way too much pessimism about the housing cycle.
So it's the elephant in the room, right? Why invest in home improvement when literally nobody is moving? It seems entirely counterintuitive. Think about it. If people aren't buying and selling houses, they aren't fixing them up to sell, and they definitely aren't renovating right after they buy. The logic seems rock solid on the surface. But in this explainer, we're going to look past that surface-level panic and break down exactly why this assumed logic is actually totally flawed.
Here's our roadmap for today's explainer. First, the frozen housing market. Second, beating the street. Third, shifting consumer behavior. Fourth, a rare valuation discount. And finally, risks and the bull case. All right, let's jump right in.
Section 1. The frozen housing market.
Okay, let's dive into this. To establish our baseline, we really have to look at the macro picture first. We need to examine the severe macroeconomic headwinds battering the real estate sector right now just to truly appreciate what Home Depot is pulling off. And you don't have to take my word for it, or even some skeptical analyst's word. Listen to this. Frozen housing market. That quote comes directly from the Home Depot CFO. A frozen housing market. That is a stunningly blunt assessment from the executive of a company whose entire business model is built around housing. They're absolutely not sugarcoating the environment they're operating in.
So why exactly is the market frozen? Well, it's basically a perfect storm of three things. First off, high mortgage rates are absolutely choking home turnover. People are locked into those sweet low rates from a few years ago, and they flat out refuse to move. Second, for the folks who do want to buy, affordability is sitting at multi-decade lows. And third, consumer confidence for big sweeping purchases is just incredibly weak right now. Historically, when these three factors line up and home turnover basically stops, large renovation projects take a massive nosedive. This is the giant headwind facing the industry, setting up what the market perceives as a major problem for Home Depot.
Section 2. Beating the streak.
But hey, perception isn't always reality. The sheer magnitude of Home Depot's outperformance here is just fascinating. The consensus estimate for adjusted earnings per share was $4.73. Home Depot delivered $4.92. That is a massive 19-cent beat. On the revenue side, Wall Street expected $47.27 billion in net sales. Home Depot delivered $47.86 billion. They beat expectations by nearly $600 million. This is literally what flawless execution looks like. They're successfully running a beat-and-hold strategy, just effortlessly hurdling over analyst expectations on both the top and bottom lines.
Building on that, this next metric might actually be the most important number of the entire quarter, plus 1.7%. That is their comparable or same-store sales growth. This isn't just a beat, folks. It's the highest comparable sales growth Home Depot has posted since the third quarter of 2022. Just think about what that means. During a period where housing transactions are sitting at historic, multi-decade lows, Home Depot is actually accelerating its same-store sales. It proves they have incredible pricing power, and they're actively gobbling up market share from weaker competitors who just can't survive the freeze.
Now, with numbers like that, you might expect management to start shouting from the rooftops and drastically raising their guidance for the rest of the year. But look at what they actually did. Management reaffirmed their existing guidance: 2.5 to 4.5% full-year sales growth and 0 to 4% EPS growth. They didn't raise it. Why? Because they're taking a prudent approach. They see the exact same uncertain macroeconomic environment that we just discussed. By holding their guidance steady, they are being realistic and conservative, not bearish. It's the hallmark of a mature, disciplined management team.
Section 3. Shifting consumer behavior. If the big macro picture is terrible, but Home Depot's micro-execution is stellar, what are the actual mechanics behind this? Like, how exactly are they pulling this off? Well, on the ground, consumers aren't abandoning their homes, they're just trading down. And this brilliantly illustrates the dynamic. The winners right now are landscaping, patio upgrades, paint, basic plumbing repairs, and hardware. Smaller, essential maintenance tasks or affordable aesthetic upgrades. The losers, full kitchen remodels, major room additions, and those massive big-ticket appliances. What you really should take away from this is that consumer engagement is still incredibly high. Home Depot remains the very first stop for the American homeowner. They're just buying a $50 can of paint and a $200 faucet right now, instead of a $20,000 custom kitchen layout. The relationship is entirely intact.
Furthermore, Home Depot isn't just relying on weekend DIYers fixing leaky sinks. Their recent acquisition of SRS Distribution is a massive play to strengthen their position with professional roofers and landscapers. The pro business is kind of the holy grail for Home Depot because it represents a higher margin, highly repeatable revenue stream. By locking in professional contractor demand through SRS, Home Depot is capturing this incredibly resilient revenue while we all wait for those massive consumer kitchen remodels to eventually bounce back.
Section 4. A rare valuation discount.
We've seen this solid business performance and the brilliant strategy, so how does that translate into an actual investment opportunity for you? Well, historically, Home Depot trades at a premium to the broader S&P 500. Investors usually have to pay up for its incredible quality, its wide competitive moat, and its duopoly status with Lowe's. But today, that relationship is entirely inverted. Right now, Home Depot is trading at a discount to the S&P 500. In fact, year-to-date, the stock is down about 2%, even as the broader market has rallied. This is a profound historical anomaly.
And Wall Street is definitely catching on to this disconnect. The average analyst price target for Home Depot right now sits somewhere between $373 and $383. Major firms, including Morgan Stanley, have explicitly called this out. They've noted that the current price reflects a level of market pessimism about housing that is just, frankly, excessive, given the actual earnings data we just walked through. There's a really wide gap between perception and reality here.
Section 5. Risks and the bull case. Now, to be truly focused learners, we got to look at the whole board. Let's walk through the risks objectively before we solidify our ultimate conclusion. First, there's a bit of leadership uncertainty. CEO Ted Decker is currently on a temporary medical leave with no specific return date. Second, there's the very real threat of a prolonged housing slump. If the Federal Reserve keeps rates high for another 2 to 3 years, the recovery of those large projects will definitely be delayed. And finally, there's margin pressure from rising labor costs and the heavy lifting of integrating that SRS acquisition. So yeah, these are real risks. However, they are manageable. Home Depot has an incredibly deep executive bench to handle the CEO's absence. I mean, this is an operational machine, not some fragile startup. The Fed has already signaled eventual easing, and Home Depot has the pricing power to offset those margin pressures.
So the crucial point is that the upside heavily outweighs those manageable risks. Here are the 3 foundational pillars of the bull case. Step 1, resilience in a downturn. They just grew comp sales by 1.7% in a totally frozen market. That's the very definition of a defensive, quality business. Step 2, attractive valuation. You're getting a best-in-class business at a rare discount to the market. And step 3, the housing cycle will eventually turn. It always does. And when it does, massive pent-up demand combined with millions of millennials finally entering their prime home buying years will create a massive, multi-year tailwind for Home Depot.
When you stack all this up, the conclusion is pretty clear. This is a conviction buy. Based on the analysis of these sources, there is a highly realistic path to a 380-plus valuation over the next 12 months, and that represents an upside of approximately 15 to 20% from current levels. Not bad at all.
Look, it's really easy to follow the crowd and stay far away from housing stocks when the market is frozen solid. But ask yourself, when the housing market finally unfreezes, and history tells us it absolutely will you have already missed out on the rock-solid foundation Home Depot is building today while it's still trading at a discount? Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll see you next time.